Okay, just do a quick sight and sound check. Okay, just wanted to make sure it was a go. So, good afternoon, everybody. I hope you guys are doing well. So, in today's chat, we're going to talk about SPX, what it's looking like on a daily and weekly chart, what the overall market's looking like. I also want to focus on the Qs because I think there's a nice setup in that. But talk about where we're going from here. So, if y'all recall last time that I was on, or maybe you've joined me in the Simpler Trading Options main room or the training room in there, y'all know that I was looking for particular levels for SPX to break above in order for me to be a bit more bullish in this market overall. And we finally broke above those levels. Last week is when we broke above the daily ATR trailing stop, which was trading around 3240-ish at the time. Right, that was a strong resistance level since the run-up that we had from March, and we stalled out there. And then we had been in consolidation ever since, and it wasn't until the 20th, right, July 20th, that we finally broke above it and turned that resistance into support. That was our first good sign that the market was trying to move higher. But the overall sign that I really wanted to see was if the weekly chart saw that break as well. So the same indicator, the ATR trailing stop here. Now, on the week that we broke it on the daily chart, going into the close that week, we actually sold off and still kept printing resistance on the weekly time frame. So it wasn't until last week, going into the close last week, that we actually broke above the ATR trailing stop and finally turned that into support. So now that we've broken that level on a weekly chart, things look good to the upside from here to me. Overall, I should say, let me preference that, overall. And the reason why is we've kind of broken above our last technical resistance level, in the case of the indicators that I have currently on my charts here. We're in a stacked up formation on both time frames, the daily and the weekly. The 10-period simple moving average is above the 30-period simple moving average, and both of those are above the 100-period simple moving average. So all of that is bullish sentiment. Momentum is starting to build to the upside on both time frames with room to move higher, right? So we're not at exhaustion levels quite yet, so that looks good. And regards to a target I currently have to the upside right now, my first target is to fill this gap, this kind of bounce down that we made on the weekly chart, where we went from a low of 33.28 and 45 cents, and then the market gapped down the next week, opening with a high that week at 32.59 and 81 cents. Right? So we kind of made this gap pattern here. And it's not necessarily a trade, it's not necessarily a signal, I should say, to take a trade off of. But to me, it's still important to track. And the reason why is most of the time on a daily chart or higher, whenever you see this gap kind of being made, whether it's a gap to the upside or a gap to the downside, there's a good probability, I'd say like an 85, maybe 90% likelihood that the price will go back and fill this gap at some point. Now, it doesn't always fill it, right? And other times it can take, just a day or two to fill it. And on the other hand, it can take over a year, right? If it's on the daily chart, sometimes it takes over a year until you fill that gap. So that's what I mean when I say that it's not necessarily tradable, but things are looking good to the upside. So that's the gap that we're looking for there. I apologize. Was checking one thing in the background with somebody. So right now on the weekly chart, what I'm looking for is a move back up to the low that we had before the gap occurred. And that low is 33.28 and 45 cents. Not too far away from where we're trading at now. So it's certainly plausible that we could see this fill happen sooner than later. So that is the gap that I'm looking for there at 33.28 and 45 cents. That's the move I'm looking for in the more shorter term. Now, I liked last week that the Bollinger Bands were flaring up on the weekly chart. What I don't like so far this week is notice how they're going back into consolidation. Also, when we look at today's trading day, if we break it down to an hourly time frame, for example, you can see that, at least for today, we had a very hard time breaking and holding above 3,300. So even though I like the overall bullish sentiment, even the intraday time frame here on the hourly chart, we're showing an overall bullish sentiment on the chart here, right? Moving averages are stacked up. Momentum's building up overall above the zero line. We still have a valid bullish signal on the compound breakout tool. So SPX, even on the hourly chart, still looks great for moves to the upside. However, I do want to be mindful of 3,300 acting as resistance. And so because of that, you might be a little cautious. We could end up gapping open tomorrow morning, trading above that level, and it's turning into support. But if we are able to break above 3,300, I certainly like the idea that we could go back and test that weekly gap around 33.28. On the daily chart, we made a similar gap to the downside here from February 21st into February 24th. The low here that we need to get is also the same low that we had on the weekly chart, right? 33.28 and 45 cents. So whether you go off the daily gap to the downside, whether you go off the weekly gap to the downside, this right now, if we break above 3,300, is really my next target to the upside. And certainly if we can break above that, if our indicators are still looking bullish like they are currently on the daily chart and on the weekly, then I like us to go back and retest the prior highs on SPX and maybe see a continuation higher overall. I like that the Bollinger Bands are starting to open up on the daily chart, so that kind of contradicts the weekly some. But we have that. Of course, the moving averages are stacked up. Momentum's moving to the upside with room to move higher, and a bullish signal on the compound breakout tool. So all of that looks good. When we also take a look at the weekly chart, the one thing I did like about the Bollinger Bands is the fact that we flared open, and even though we're going back into consolidation, notice how it's made more room for the price to continue higher. If they had continued on this consolidating trajectory that we had a few weeks ago, right, we would have ran right into that upper Bollinger Band, that second deviation upper Bollinger Band with the underlying price. Instead, they flared open for a bit, and even though they're going back into consolidation, now instead of it kind of being a slight resistance level around 33.40, which is right around where that was trading at, now we have resistance up here around 34.25. So what it allows is it allows for the price to move up and certainly fill that gap. It allows for the price to even go back up and test the prior highs and still technically be within the comfort zone. And what I mean by that is that the price trades in between the second deviation Bollinger Band on most time frames for the majority of the time, right? Here on the weekly chart, you can see the majority of the time, the price is trading in between these inside blue lines, which is the second deviation Bollinger Band on my chart. Every now and then, they'll move outside of that level, right? Or maybe trade right along the upper Bollinger Band. But typically, they trade within that range. So the fact that the Bollinger Bands have opened up, even though they're going slightly back into consolidation, they've opened up and basically allowed the price to be able to move up to these levels and still stay within the comfort zone. So that's why I still like the overall trend bullish, certainly, right? Everything to me on most of the time frames here are still pointing bullish right now. I'm not going to fight the trend. And now that we've broken above this resistance level, right, I might not even consider putting on some hedges, or if I do, they're going to be, a one contract extremely inexpensive trade, because I just think we're moving to the upside from here. But I will be cautious, certainly, of psychological levels as we move up along the way. So 3,300, where we're at now, is a slight sign of caution for me. And then I have my targets to the upside if we break that level, right? 33.28 and then 3,400 respectively. Now, the other symbol I wanted to take a look at is the Qs, because I think out of all the indexes that I personally look at, right, NDX, SPX, RUT, the Qs to me, NDX, is showing the best bullish setup overall. And the reason why I mention that is because unlike SPX, the Qs and NDX respectively have well broken above the highs that we had back here in February. So this is a retest of the highs. like SPX needs to do, like IWM, RUT need to do, right? We've already broken the highs that we had back in February, and we've continued to make new all-time highs and this overall bullish trend. And so that's the first good thing, right? We don't have any psychological price resistance levels to really stop us on this bullish sentiment currently with the Qs. And of course, if you prefer NDX, with NDX either. The other thing I like about the Qs is, much like SPX, right? Its Bollinger Bands are flaring open. We're in a stacked up formation. Momentum is building up. Today we confirmed a second bullish signal on the compound breakout tool. So now, as long as you have two of the three lines printing, either bullish or bearish and in line with each other, that's a valid signal. So in this case, we now have two of our three lines showing a bullish sentiment. So now this is a valid bullish signal to the upside, especially when it's in line with the trend and everything else we see here. The third thing I really like about the Qs is that we've been printing a daily squeeze that hasn't fired yet. Now, I actually meant to try and get into a trade on this into the close, and it just kind of completely slipped my mind. And by the time I remembered, it was past that 15 minutes of extra trading that the ETFs and, well, some of the ETFs and the indexes allow to occur. So I missed my opportunity today. We'll see if it still looks like a good setup tomorrow. But you can see with the squeeze still not having fired, and usually that meaning a greater than expected move, and we're getting all of these other bullish signs, it's a good probability that we'll see this continue to the upside and an overall bullish trend once again, breaking out of this consolidation that it too on the Qs was trading in before it had a lot of those tech earnings announcements. On the weekly chart really quickly, right, things certainly remain in a strong bullish pattern here. We are starting to get high on the momentum on the awesome oscillator, but until we start to see some red bars occur, I wouldn't take this yet as a sign of consolidation, because we can technically keep adjusting the axis higher. We've actually been doing that since, I would say, about July 13th on the weekly chart. Prior to that, right, this was the top of the axis, but because of the Qs had such strong bullish sentiment continuing in this trend, the axis continued to adjust itself higher with the green bars that we've been printing. And so now, until we get a few red bars like we did here, I wouldn't necessarily consider this the top of the axis yet, right? It could just keep going. We also still have a very strong valid bullish signal on the compound breakout tool. Now, this too has been printing for a while, but it still remains valid. It hasn't canceled out yet. We're still in an overall bullish trend. Bollinger Bands are starting to flatten out a little bit, right? They're not as strongly flaring open as they are back here, but there's still plenty of room for the Qs to go up before it hits that resistance level, which is currently around 281. So it still has about a 10 to 12 point move. It could happen here to where we could look to take profits before it starts to stall out. So if we do end up getting a pullback tomorrow in the Qs, and we can hold 261 as support, which is the 10-period simple moving average, or we continue higher, but maybe we're still printing the squeeze, we still have valid signals here, I wouldn't mind jumping into a rising bias trade. So on the Qs, let me pull that up on the option chain here. If tomorrow morning things still look valid, if things still remain bullish, there are a few different ways you can play it. You can certainly play it as a short-term trade, right, with the idea that we are going to move higher sooner than later this week. If I were to do that, I'd probably keep it as a vertical spread just to keep my capital risk in line, and look at something like the August 7th, 269, 272 trade. It's about a 3-point width spread. It's a $1.48 net debit, so that means it is a $1.52 profit potential, so it's pretty even on the risk versus reward. It's already a little in the money, considering that we closed today at $2.69 38 cents, so that makes sense, right? That it has some intrinsic value built into it. And if we do break to the upside, it wouldn't take much for the Qs to make a 3-point move, much like it did today, to all of a sudden encompass the spread in the money and allow for a quick profit to occur going into the close this week. So that's one way you could trade it as a shorter term trade. Otherwise, if you're trying to take advantage more of the actual squeeze that we have going on here, oh, let me just go back to my charts here. There we go. If you're trying to take advantage more of the squeeze itself that we have here, right, you might give yourself a little bit of time. Now, the squeeze on the Qs, as we look back, at least in the past year, they usually don't print for very long, right? So this should, or, just looking at the past data, would probably start to fire within the next few trading days. But you still, just in case, you never know what's going to happen, should probably give yourself some time for it to do so. So for myself, I'd go out to at least August 21st. Usually I like to go out at least 30 days in time. But to me, it looks like the Qs are already starting to see this move occur, so I might keep it a little bit shorter dated and go out with August 21st, the monthly expiration, and still look at getting into a long call. The benefit about the Qs, of course, is that it's very liquid, right? So it has a very high open interest, usually a very narrow bid and ask. It's not very hard to jump into a trade and then watch the move occur. When we take a look at the delta typically I like to look for is a 0.7 delta. So let me add some strikes to this. Oops. There we go. Nope, still need more. Let's try 30. There we go. So the 0.7 delta here on August 21st is an 11.76 cost basis, and that's because it's the 261 strike. So we're already well above $8, almost $9 in the money from that strike. So it holds quite a bit of intrinsic value. And it wouldn't take much for it to get to break even, right, by this expiration. It just needs a few dollars of a move higher in order to do that. The nice thing about going with a 0.7 delta like the 261 strike is that for every dollar the underlying asset moves, your strike, for the most part, increases by that delta. So it increases by 70 cents in this case. And of course, as it continues higher, it starts to get a higher delta, which means a better profit. So that's why I typically try and stay in the money on these trades if I'm looking for a long call. If this is too expensive for you, right? Maybe your normal risk tolerance is around $500 per trade, and this is an over an $1,000 risk just on one contract. You could either consider going further at the money. Just keep in mind that you need a stronger price move to, one, get a similar number profit compared to the 0.7 delta. But second of all, to get back to break even for what this strike is. For example, the 268 strike is only about $1.38 in the money, but its current cost basis is around $7 to jump into the trade. So that means we basically need to see the underlying price by August 21st move up $6 for that to seem at a break-even point. Now, of course, right, as it moves up within the next few days, you're going to be able to take a profit because it will just move up in value. There will still be a lot of extrinsic value because of the time on the trade to where you can take a profit that way. But that's what I would be looking at overall, right? Is something like a 0.7 delta or something slightly in the money to see that move occur. Otherwise, if you want to give yourself a little bit more time or maybe stay out with the August monthly, I'd still, if this is still too much capital, just consider going with the spread, right? The unfortunate thing about a spread versus a long call is that it limits your overall profit potential, right? It's not an unlimited profit potential like a long call can be, but it also is a much smaller capital risk typically. And the benefit of a debit spread over a long call is, let's say it takes us actually into August monthly expiration to see a 2 or 3 point move. Well, if you're in a long call, right, especially if it's one closer to at the money where it holds not that much intrinsic value in it, and it takes us a few weeks until the August monthly expiration, even then you only get a 2 or 3 point move, that long call is probably sitting at a slight loss, maybe break even, but probably a slight loss compared to where you got in, especially if it's closer to at the money. Whereas if you jump into a spread and you only see a 3 point move up from here, right? Well, the spread is still completely in the money, so it still allows for that max profit potential on the trade itself, which in this case, if you went with the August 21st expiration, did the same strikes as we talked about for this week, the 269, 272 strikes, cost a little bit more, right, because there's more time. It's $1.63, but it still allows for a $1.37 profit potential. So for myself, if I were to take this trade tomorrow, I'd probably keep it shorter term either this week or next week with the vertical spread, and probably look at a 3 to 5 point width spread overall to jump into. But like I said, if you have the capital to do so and you just want to give yourself a little bit of time to allow this squeeze to fire, right, in case it does pull back and it kind of stays in that choppy range maybe for another week or two, then the more conservative way to do that is to give yourself time on the trade. Now, like I said, I typically like to go 30 days out, but because the Qs can be, somewhat volatile for an ETF and we can see some nice movement, and there's certainly liquidity here within the strikes because so many people trade it, right? A lot of liquidity here. I wouldn't mind going with a slightly shorter term expiration with the idea that this squeeze will end up firing sooner than later. So I think out of all the setups, I certainly like the Qs the best. Of course, if you want to correspond this with NDX, maybe you have a larger account that you want to trade, right? NDX, similar situation with the chart pattern. Bollinger Bands are flaring open, bullish sentiment. We have momentum building up with plenty of room to move to the top of the axis. We have a bullish signal that validated itself today on the compound breakout tool and a squeeze that hasn't fired yet. So all of this is looking good. And if you wanted to trade NDX, in that case, I would definitely keep it to a spread, right? NDX is rather expensive. And they have very wide strike increments, so that's always good to know. I'd stick with the Friday expiration. I know it has some intra-week, I should say, expirations like it did today and on Wednesday. But I'd probably stick with either August 7th or August 14th, right? Give myself either until this Friday or next Friday to see follow-through. Let's say you wanted to do it shorter term and make it this Friday. Then I'd still look for bullish sentiment. In the case of NDX, because it's a bit more expensive, I might consider going out of the money. Just keep in mind what your strike increment is here. So it's usually 10 points minimum of a strike increment on NDX, unless it's one of the 25 endings. So, 25, 50. Of course, it wouldn't matter because that still keeps within the 10-point strike increment, but then 75, right? So that allows for a 5-point spread. So if you do have a smaller capital amount that you want to risk, maybe going slightly out of the money at a 5-point strike level, right? So the 11,070, the 11,075 on this week's expiration on the Friday is about a 270 cost basis according to the mid, and is a 230 profit potential. If you want to give yourself a little bit more room but keep within a 5-point spread width, you might consider the 1120, 1125. Right, that still keeps it as a debit spread here. It's about a 220 cost basis, 280 profit potential. And as we know, NDX can easily move. Today it moved roughly 150 points. So a 150 point move up from here would put either of these spreads, either the, well, maybe not the 1120, 1125, or the 11,070, 11,075 would put either of the spreads in the money, because if we did see a 150 point move again tomorrow, that means we're trading out about 11,200, right? So both of these spreads would be well in the money to allow for a quick profit that way. If you don't mind the 10-point spread, then certainly consider that, right? You might be able to get a better risk versus reward scenario. Here, if you did the 11,120, 11,130 strikes, it's still about a 445 cost basis, right? 55 profit potential. And that's, of course, because, like I said, NDX is very volatile. So even if you go out of the money with a wide width spread, anticipate that you're going to have to pay a bit more unless it's really far out of the money, which, I wouldn't necessarily go too far out of the money. I'd probably stick around these strikes here. And for myself, I'd probably lean towards that 5-point spread to keep my capital risk a little bit lower. This is why I highlighted the Qs first, because to me, the Qs are a lot less expensive. And if you did want to do something like a long call, that's usually a bit more flexible to be taken in any sort of trading account, right? Large or small. Whereas NDX, if you're trying to play a long call or, do a wider width spread, it's going to cost you a little bit more. You usually have a bigger account when you're doing something like that. And then really quickly, just to show you RUT, right? RUT still hasn't broken the level. So it's usually the one, at least right recently, it's been the one that's really lagged behind. So it was the one that sold off first, and it's been the one that's had the hardest time to recover. This is still pretty far away, relatively speaking, compared to the highs that we had earlier this year, when we take into consideration SPX being very close to that level and NDX already surpassing it, right? RUT, on the other hand, the Russell, is still over 100 points plus away. And on top of that, RUT and in correspondence IWM has yet to break above the ATR trailing stop. So that's why for IWM RUT, if you're trying to play that bullish, definitely wait for that resistance level to break, right? You might say that you've maybe started to miss out on the move, but it at least, and even though it's a bit more conservative, it at least gives you that confirmation that we're breaking resistance and continuing in a bullish sentiment overall. So there's still a lot of consolidating signals even on the lower indicators right now. The choppiness in our signals and the compound breakout tool is a sign of consolidation. We have momentum, even though we're zoomed in here. Notice how it's relatively flat, hugging the zero line, and it's been choppy with red and green bars. That's usually a sign of consolidation. And the weekly chart still actually has quite a bit of room until it hits the ATR trailing stop there. That is at 1567. So you could actually take a trade into that level, but notice where we're stalling out at the daily chart is actually in line with the 100-period simple moving average and also the psychological level of right around 1500. So once again, kind of like SPX on the weekly chart, I think I'd prefer to see into the end of this week we break and close above 1500. Ideally that we're also breaking above the ATR trailing stop. And if so, right, and you want it to be bullish on RUT or IWM, then I'd play it up into the ATR trailing stop around 1567, 1570. But if it stalls there, I'd be taking my profits quickly, right? There's no need to try and continue to hold on to a trade if you have a profit and there are signs of resistance or signs that the chart in general is about to stall out or move against your direction. So that's what I'm seeing in the overall market. I think in general, we're seeing some bullish strength that's trying to peak out, especially with some of the earnings announcements that we've had recently. However, I'm not going to discredit, right, the unemployment rate. I'm not going to discredit what the long-term cost to this economy could be, even with the Fed trying to prop it up as much as it can, even with these relief bills, trying to find an agreement and go through, which would be great, certainly. But even as this whole coronavirus thing, this reopening starts to ease up, the question is how many people are going to immediately jump back in to going out and everything else? And is that relief from the feds, is that relief from the government going to be enough to keep us up here to when it comes back up, we just continue in a bullish trend? Or is that still going to cause some longer term effect for a pullback? Now, for myself, I'm not going to fight the technicals that we saw break on SPX on a weekly chart, right? So I'm going to be playing it more bullish, but I still might be lighter on my capital. I still might be having one or two hedge trades out there just in case things pull back. Now, at this time, I'm not going to keep them very, I'm not going to put a lot of money into those hedge trades. I'm probably only going to do a one contract hedge trade sort of situation. But it at least allows for a little bit of a safety net if we do pull back. So I like everything that I'm seeing. I like the Q's NDX the best. I think SPX is trying to move up there. If we can break 3,300, then you guys know my targets to the upside. And then RUT is just, it's the weakest out of all of them. So that, to me, is still kind of lagging behind and needs to see a little bit of a break. But if it can, once again, I wouldn't fight the technicals, right? I'd still play it to the upside. So that is it for me today, guys. Thank you so much for joining me. Hopefully that gave you some trade ideas, gave you an overall view of what I'm seeing on the market, on targets that I have to the upside on some of these indexes. And as always, for my Star Wars fans out there, may the trade be with you. And I look forward to talking to y'all again next time. Bye.